All right, let's talk about it. You're holding a crypto, it's seen better days. And you're not alone. The big question on every bag holder's mind is a really tough one. But you know what? We're going to tackle it head on. So let's just dive right in.
Okay, first, let's just try to get our heads around the sheer scale of the problem. This number right here, 11.6 million, it represents well, a massive graveyard. But what does it actually mean?
Yeah, that is the number of cryptos that went to absolute zero just last year. I mean, think about that. That breaks down to over 32,000 tokens dying every single day. Now, sure, most of them were, short-lived memes, but a lot of them were actually legit projects that just slowly bled out in people's portfolios.
And that brings us right back to the crucial question, the one you're here for. Is your crypto, the one you're holding on to, is it actually deceased, or is it just taking a power nap, waiting for its moment to come roaring back to life? Well, let's figure out how to tell the difference.
All right, so to really understand what's happening now, we've got to take a quick look at the past. Welcome to the crypto graveyard. The casualties here are piling up faster than you can possibly imagine.
So what's really kind of mind-blowing here is just the sheer acceleration of it all. Last year wasn't just a bad year, it was a mass extinction event for crypto. Get this, 86% of all crypto deaths in the last 5 years happened in that one single year. It was largely kicked off by that big October liquidation event that just, poof, vaporized $19 billion from the market.
Okay, enough with the grim statistics, right? Let's get practical. How can you, right now, perform a quick checkup on your own holdings? Well, here are 3 dead simple, clear signs of death.
Now, before we get into the really deep, complex forensics, I want you to think of these next 3 points as a simple, preliminary death certificate. If your token checks these boxes, well, the outlook is not good.
Okay, first up, no volume. I mean, this is the trading flatline, right? The EKG has gone silent. For context, CoinGecko calls a token inactive if it has 0 trades for 30 days straight. Second, it gets delisted. Being kicked off major exchanges, that's basically a death sentence. It just kills all the liquidity. And number 3, it was rug pulled.
And we really got to talk about the rug pull, because it's not so much a natural death as it is a straight-up murder. The developer just drains the entire liquidity pool, takes all the money, and vanishes. Poof, gone. And the crazy thing is, the token still exists in your wallet, but it has absolutely 0 extractable value. It's a ghost.
Okay, so those are the easy ones. But what about the gray area? Because this is where things get really tricky, and honestly, it's the dilemma that trips up most investors.
So, what if your token isn't officially dead by those first 3 checks? I mean, the price is down, let's say, 90%. The volume is anemic. Is this the final gas before it goes to 0? Or is it the quiet, sneaky beginning of a massive comeback?
This is the whole ballgame right here. It boils down to 2 possibilities. On one side, you have distribution. This is when insiders are dumping their bags on the public. It's that last trickle of volume, a slow, painful bleed to 0. But on the other side, you have accumulation. This is where smart money is quietly buying up everything the public is panic selling. They're loading up at the bottom. And the scary part? They can look almost identical on a price chart.
So how do we tell the difference, right? We have to go deeper than just the price chart. We need to become crypto detectives and check for vital signs. Let's look at exactly what you should be looking for.
I want you to remember this quote. Market cap is a vanity metric. Liquidity is a sanity metric. This is absolutely crucial. You have to look past the big, flashy numbers. Market cap can be so misleading. What really, really matters, what keeps an asset breathing, is liquidity.
So picture this. A token might show a beautiful $100 million market cap on a crypto tracker. It looks healthy, right? It looks valuable. This is the vanity. But then, you check the sanity metric, and you see the actual liquidity in the pool is only $50,000. We call this ghost liquidity. And what it means is, if you try to sell even a small position, you would single-handedly crash the price. That $100 million market cap, it might as well be written in crayon. It's meaningless.
Okay, so here are a few more vital signs you need to check. Look at the on-balance volume. Is buying pressure actually absorbing the selling, even while the price is flat? That could be a huge tell. What about GitHub activity? Are developers actually shipping code, or are they just faking it? And what about locked liquidity?
I mean, can the dev just drain the pool tomorrow, or is it locked up? And finally, you gotta ask, is that volume even real? Or is it just a few wallets wash trading back and forth to make it look busy?
So after all those checks, there's one final concept that pretty much trumps everything else. If you really want to know if an asset can recover, you have to understand this one thing. Market structure is king.
And here's the thing about market structure. Fundamentals, they don't really matter if the market structure is broken. Seriously. A so-called zombie project with zero development can still rally like crazy if the chart shows a bullish reversal. And on the flip side, the best project in the world isn't safe if its chart is broken and trending down. The chart tells you the real story in real time.
I mean, just look at Solana. It is the perfect real-world example of this. After the FTX collapse, it was down 95%. Everyone, and I mean everyone, wrote it off for dead. But then what happened? It spent most of 2023 in this sideways accumulation range before it reclaimed key levels and then went on an absolutely massive rally. The signs are right there on the chart the whole time.
In this quote just nails the lesson here perfectly. Buying during the range is brave. Buying after the reclaim is strategic. See, trying to catch the absolute bottom in that sideways chop, that's just a high-risk guess. But waiting for the price to prove itself, to break out and reclaim that range, now that's a strategic, calculated move.
So let's really break this down. The anatomy of a trend. On the left, accumulation, the signs of life. The price finds a bottom, it enters a range, and you get this key event called the spring. It's this fake breakdown below the range that shakes everyone out right before a sharp reclaim. Compare that to distribution, the signs of death. It just keeps making lower lows and lower highs, slicing right through support levels with no defense, no fight at all.
Look, the hard truth is, most dying cryptos are probably going to stay dead, but not all of them. And now you've got the tools. You know how to check the vital signs, how to tell the difference between vanity and sanity, and most importantly, how to read the story the chart is telling you. So the final question goes back to you. What's your diagnosis going to be?